So, what are the three biggest deterrents or obstacles to building wealth? The three things that are weighing you down or holding you back or getting in the way. So, the three biggest deterrents to building wealth are taxes. Number one, first and foremost. Number two is inflation, right? The cost of goods and services going up every year. And number three is market volatility. Now, this can be in any market, right? Real estate, the stock market, any other type of asset class. For taxes, there are three different types of income taxes subject to tax, right? There's the earned, which are salaries and wages, your passive, and your portfolio. Portfolio, your interest, dividends, and capital gains. And then secondly is inflation. That's our rising cost of goods and services. And third is market volatility. As mentioned, it's unpredictable, there's risk of loss, and it takes time to recover for any asset class. So is there a financial vehicle that we can use to overcome these obstacles so we can build wealth? Yes, absolutely, there is. And that financial vehicle is the indexed universal life contract. Why? Because of these three strengths. It has liquidity, safety of principal, and predictable rates of return. And three of its greatest benefits of the IUL are tax-free growth and tax-free access to your money. And as inflation occurs, the index goes up because it's tied to things that inflate. And you are protected from losses. There really is no downside because you're only participating in the gains, as I'll show you in a minute. So the taxes, the burden we have historically is about 40 to 50% of our lifetime income. And you can see here that inflation, three different periods, their inflation was approximately 4 to 6%, which is really higher than we want. Typically, you'll see 2.9% or 3% or less. And after COVID, we saw 12 to 15%. The official, reporting, as you see there, was somewhere in the 7 to 9%. And then more recently, we have 6 to 8%, although it was reported 3 to 4%. I've heard reports as high as 25% after COVID. Of course, if you're printing $1 trillion a year, you have to take into account how much money is in circulation versus how much money are you putting into circulation. So if you're adding 25% of what's in circulation, technically you should be inflating costs by 25% and devaluing the dollar. So there are IRS codes for the Universal Index Life Insurance, and these were TEFRA and DEFRA 1980s. TEFRA determines the maximum amount of premium paid and the minimum amount the death benefit. DEFRA is basically the speed, so it limits the amount of premium that can be paid on a life insurance policy relative to its death benefit. So those two together basically make up a corridor, how much life insurance you can have versus how much cash value growth there is and death benefit. And then TAMRA is your Technical and Miscellaneous Revenue Act. It limits how much money can be paid for the first 7 years. So that's a speed. How quickly can you fund your policy relative to how much you want to put in and how much the death benefit is. And then the other tax codes are 101A, that's the death benefit. It states that it's tax-free, when your heirs receive the insurance if you pass away. 72E, the money can be taken as a loan, and that's considered tax-free. And then 7702 establishes the criteria for tax-free growth and tax-free benefits. So the IRS knows all this. They are the ones who put it together, so you're not really getting away with anything. It is just a financial vehicle that has those benefits. So your qualities of the IUL are liquidity, safety, and predictable rates of return. Let's look at some other financial vehicles here and compare the difference. So you can see if we go through the different types of asset classes, your safety, predictable rates of return and tax-free access, there really is no other asset class that compares the IUL. So if you look at the IRA, it's not safe, right? Or 401k, it can go down. Your value of your account goes down if the market goes down. You have a limit to some of those, how much money you can put in. Tax-free access, no. You have to take it out, wait till a certain age, right? And if you take it out early, it's not penalty free. Real estate, it can be liquid. It's not as liquid as the you really want, right? Liquidity is getting your money quickly. So if you have to sell that asset, that property, that can take time. If you have to go borrow against it, that could be obviously a lot quicker, but you still have to fill out forms, wait for the bank approval, and that process can take some time, especially if there's other things that need to be done, like an appraisal. Oil and gas. I've had some involvement in this, and oil and gas are great for tax benefits because you get a tax reduction, not a tax deduction, but a tax reduction that you can take depending on the amount of oil and gas investment that you've had. And it's not liquid. You can't take that money back out very easily. The only way I know of is to sell your position or shares to another. And of course, there's not predictable rates of return. Nobody knows where the oil and gas prices are going to be. We hope that the oil company likes when there's somewhere between 65 and 80. Gold and silver historically has been a hedge against inflation, but again, we don't know where those prices could go. They could fluctuate. The last 20 years has been a great position if you've owned gold and silver. It is liquid. You can go to any coin and silver shop and liquidate your gold based on the spot price of gold or silver, which we've done that as well. CDs, same thing. They're liquid, yes. Safe, yes. There's predictable rates of return, but it's not very good, right? CDs don't really provide much rate of return, but some people use those because of those three things, right? You can access your money quickly. It's safe. You're going to get a certain return. However, you do pay taxes on the gains, and it can be a penalty assessed if you take it out too early. And then annuities, a lot of people use these for retirement. We like annuities for certain reasons, but they are liquid. Safety, yes, they're pretty safe and pretty predictable, like the IUL, but tax-free access, no, and penalty access, no. So the penalties and the access comes in, there's a limitation to how much you can take out with an annuity. Typically, you'll see 10% per year as a max. Anything over that, and there is a penalty. And then mutual funds, again, those are liquid, but those don't check any other boxes, as far as the safety and et cetera that you see there. Okay, so let's compare it to the IUL. Again, so here's the other ones listed. And an IUL is liquid, it is safe, has predictable rates of return, tax-free access, there's penalty-free access, and the fees. So this is, you see an asterisk there. The fees are because you have the cost of insurance, but keep in mind that it gets cheaper the older you get. So as that cash value grows, you have less death benefit that you're paying for because the cash value is approaching the amount of the death benefit. And so the insurance should get cheaper because there's less insurance that you actually are on the hook for, if that makes sense. So how to most effectively structure your IUL for living benefits. And this is key. You want to minimize the death benefit, so get the least amount of life insurance as possible. And you want to maximize the cash value for accumulation, right? Because this is living benefits. You want to have money to live on. And so you want the most accumulation as possible. You also want to fund it as fast as possible. And we always say as much as possible within your budget. That is because the quicker you put money in, the quicker it starts earning interest and has time to compound. And then we always choose historically high return indexes and rebalance and reallocate each period. And each period is, generally speaking, most commonly is 1 year. There are 2-year and 5-year periods as well to choose from, and they can offer a little bit better rate than the 1 year just because you're making that 5-year commitment. So here's the IUL design. It's just kind of a crude visual, if you will. You can see the maximum cash value here. You know, we want the most amount of your money that you're putting in to go to the cash value and the least amount to pay for the death benefit there. And of course, we want to follow all of the IRS tax code. That's the TEFRA, DEFRA, and TAMRA to make sure that it's within guidelines. And the insurance company, with all of their software, it's very careful to make sure that we don't go over those guidelines. Otherwise, it becomes a taxable event. So the software is real good at providing that limitation. So this is what happens. You can see your cash will grow, right? And the death benefit will actually tend to go up a little bit too. Again, this is to maintain that corridor, which is the difference between how much cash value you have and how much life insurance. So if you keep putting money into this and it keeps growing, the life insurance, you know, the death benefit will tend to creep up there a little bit every year until you stop putting money in. And again, that goes along with the IRS tax codes. But this is still max funded. You're still maximizing the amount of cash accumulation. So with the design indexing, you want to select and balance your cash value. And there are several different indexing opportunities. Different companies have their own brands and choices. S&P 500 is the most common that we find the different carriers that we use will provide. These are some of the brand names of some of the indexes that we see across the board. So when we're choosing an index every year, you know, we're going to rebalance and reallocate. But these are some of the examples of the approaches we can use. So there is the opportunity to get a fixed rate, and you could see there 5.4%, somewhere around 5% is common right now in year 2025 for a fixed rate with the different carriers. But there's a conservative approach where there's no bonuses and no charges, a moderate, aggressive, and very aggressive. So there is the opportunity for the very aggressive approach where so the 40% multiplier basically means for every dollar you put in for cash value growth, it's like putting $1.40 in, right? Because a 40% multiplier bonus. And for that, there is a 1% charge. So there's a slight risk to that, but we find that it's very worthwhile. And you can balance money over all 4 of these or 5 of these if you want. You know, put 20% in each one: fixed, conservative, moderate, aggressive, and very aggressive. So just depends on what our goal is. If we want to be aggressive, maybe we could put 50% here and divide up the other 50%. But we have the flexibility there. So there's liquidity with the IUL, and there's 3 ways that it becomes liquid. The first way isn't great. You pass away and your heirs get the death benefit. Just a side note here, we always recommend, if you can, to set up a trust and make the trust the beneficiary. That way, your family doesn't just all of a sudden get a whole lot of money to go ahead and spend the way they want. And you can set guidelines within your trust that money has to be put back into the trust. And that's a way to build generational wealth so that money continues to stay there and grow. The second is withdrawing funds. That's not very smart. So you're actually taking money out of this stack of cash value growth. And so if you're taking money out of it, then it's gone, right? You just don't have it there at all. And the third way, and this is a smart way, is to take it as a loan. So the insurance company will give you a loan on a portion of that money, although the entire amount will stay there on the ledger as if it's still there, and it will earn interest if that's what you want. You can do a fixed rate, like I said, or you can choose the aggressive. And so the entire principal is staying there earning interest, even though you took a loan against it. So when you take that money out, again, there's choices. You can do the zero net cost loan where like whatever the interest rate is for the loan that you took out, they will credit you that interest on that portion of money that you took out. The second is the indexed loan. And so your interest rate, let's say, is 5%, just for example. The index loan means that that portion of money is also still going into an index and having the opportunity to earn whatever gains the market is showing for that year. So if that index went up 10% and your interest rate on your loan's 5, then you earn the difference just for that portion of money, not for all of it. So for whatever you took out. So with liquidity, there's the zero wash loan. Like I said, your interest cost is offset by the interest credited. And then the index loan, your interest cost can be offset by the interest earned and the opportunity to earn more. And like I said, 10% would give you the spread of 5% earned. And so here's for demonstration purposes, not guaranteed, but just a quick example, because 10% is easy to calculate. If you had $1 million in there, you could take a $100,000 loan, and let's say the index performs 10%, every year, for example, then your credit would be, $100,000 essentially. You could take 10% out each year, of course, subtracting for the portion that is borrowed. Safety, this is safety of principal and safety of funds and safety of the company. So your principal with an IUL, it's safe because you don't participate in the losses. You only participate in the gains. So if the market was down 10% for the year, your account would not be down at all. It would be zero. And some companies actually offer a 1% rate. So you could still, in fact, get a 1% return if you were participating in the indexes and they were down for the year. Safety of funds, right? So the down market doesn't affect your account. And then companies. So in 2008, when we had that terrible crash, there were something like 350 plus banks that went under. Not one insurance company was closed because of that crash. In fact, banks were asked where they put their tier one capital, and a large percentage of their tier one capital goes to the insurance companies because it's the safest place to put it. And so as far as predictable rates of return, we can look back at any 25 consecutive years over the last 80 or so years and see what the averages are over those 25 years. Now, again, any 25 consecutive years. And if we average that out, we're looking at somewhere between 8 and 10%. Okay, so that's a historical average. And so going forward, we expect that to be the same. So the gains, this is another thing to keep in mind. Your gains are locked in for each period. Again, I mentioned this before. Each period is generally a year. That's the most common, although there are 2-year and there are 5-year periods as well. But once the year is up and you've had your gains, you can lock those gains in. As a matter of fact, we have one carrier that will allow us to lock gains in at any time during your period, during the year. So let's say the market is up 20% the first 6 months. You can lock those gains in and not worry about what the next 6 months does. If the market was down those second 6 months, if it was down 10%, you're not participating. You're already locked in your gains of 25% or whatever the increase was. So that's just one carrier example. So here's a quick review. So the IUL is liquid. That means your funds are available quickly, no qualifying, no applications. It's safe, protected from losses, and your money is in good hands with the insurance company. And the predictable rates of return. You have the tax advantages, right? Tax-free gains, tax-free access to your cash. And loans do not deplete your principal. They can still be earning for you, even though you took a loan out. So for more details on how an IUL can work to help you reach your financial goals, you can contact us today. I'll be happy to show you an illustration that's customized for you and your needs and your goals. I'm John Havey with Life Legacy. Thanks for watching.